Hello, everybody, and welcome to my update on Opendoor. So today I was going to make a much longer video on Opendoor, but then I realized that I probably already had too much content for this video, so this will be a two-part video. And the topic of this video is no, Mr. Market. Opendoor is not going bankrupt. And Mr. Market just has a change of heart. As Ben Graham tells us, Mr. Market is manic depressive, bipolar. He doesn't know. He doesn't know whether he likes his stock or not. And Opendoor has been brutalized by the media, brutalized by shorts, people shorting the stock. Um, and Opendoor is not the only stock that has been brutalized. In fact, I can think of hundreds of companies. Of course, I don't buy them all. I only buy the best, what I think is the most promising, at least after an analysis. But they've brutalized so many companies, and Opendoor is just a prime example of that. So today I wanna focus on Opendoor as an example as to why I think Mr. Market is just unfairly brutalizing these stocks per its mood swings, and really not, really not being objective at all. And investing is usually more of a money making exercise, right? But when it comes to Opendoor, I actually I have very strong moral conviction. I actually, I mean, at this point, this stock is more of a statement stock than it is even anything else. I think they have the better approach to real estate. I think real estate, the way it's done today, with a 3% fee when you sell or when you buy, I mean, realistically, today, with the state of technology, 1% of that fee should not go to the real estate agent, realistically, because uh, that first part of the search, you do it on your own. You do research on your own. Information is free today. You do it on these apps that are built by for-profit companies that are not necessarily rent seeking. So I just think Opendoor is a more fair way to do real estate. It's a more fair way to do business. It's just a better business. It's righteous. So I have strong um, kind of a moral conviction on Opendoor as to why I think they're going to win. Just because rent seeking is not the way, transaction costs are not the way of technology. We live in a zero to no or low marginal cost society. Our society has very low marginal cost, and so 6% plus closing fees whenever you buy or you sell a house is absolutely insane. And so I think Opendoor is going to fix that. So let me get into the video. And before I get into the video, I have a little bit more to say. I picked up more shares at around 160. I was like, the price is absolutely meaningless. It doesn't reflect the fundamentals. When I bought, I remember clearly CNBC was bashing Opendoor for like almost 30 minutes straight, saying they were going to go bankrupt. With really no reason but the value of the bleed, right? The value of bleeding, and if it bleeds, it leads. That's really the only reason why they did it. Not looking at the fact that Opendoor is actually trying to disrupt an industry for the good. I think of a lot of people, the home buyers. I mean 1% on a home both ways is extremely significant. I mean, homes are very expensive. This is significant. You're talking about, a year and a half of effective savings rate for people. This is very significant, and so it's time. It's time. I think it is time. Um, so again, I've lost money on Opendoor, like I think most of us who have been in the stock. I've lost money on Opendoor. So it was a bigger position, it's a smaller position now, but when I did two transactions with Opendoor. I sold my former primary residence and bought my new primary residence with them. So they saved me 1% each way. And with the money that they've saved me, actually, I'm still ahead. Like I've lost less money investing in Opendoor, despite the catastrophic drop in Opendoor, I've lost less money than what they've saved me. And so I think it's a 0 to 1 company. I think it's a 0 to 1 move because obviously they start with 1%, but down the road, I have little doubt that they will save you more than 1% on the transaction. And if it goes to 0, it's okay. Opendoor still created value for me. And I think Opendoor creates a lot of value for any buyer that buys with Opendoor or any seller that sells with Opendoor. Opendoor creates a lot of value for you. Opendoor is a business that is best cost. It takes the approach to business of a win-win transaction. It's not rent seeking. It's a company that I think really has the customer centricity of Amazon. It's a customer centric company. And of course, the reward that you get for being customer centric is a potential monopoly. That's the reward of Amazon. Amazon is the monopoly on stuff, at least online stuff. Well, perhaps Opendoor is shooting for the monopoly of the digital real estate experience. But that's really the price that you get for sharing the benefits of an industry with your customers. And that's what Opendoor does. So I really believe in this company. I really, really do. And there's so much wrong going on about this company from the market, right? I don't mean the company. The company has some turmoil, but the backlash that they've had for that turmoil, in my opinion, is completely unwarranted. I mean, look at this. I IPO'd at 10, right? Like most SPACs. And it makes you wonder how much Opendoor is down because it was a SPAC and because it's grouped as a SPAC stock in algorithms. And algorithms are just punishing all SPAC stocks regardless of their potential. So it listed at $10, right? Like most SPACs, and doubled 20%, and then it lost 95%. And actually, this is after being up 26% today. They were more like 96% down yesterday. So it's insane. It's been an insane roller coaster for a company that is righteous, for a company that is customer centric, for a company that wants to revolutionize the industry. I think for a win-win. And frankly, if they revolutionize the real estate industry, they're gonna save 1% plus 1% for any transaction, because if you sell a house, you're going to buy another house. So anytime someone does a transaction, they're going to save 1% and 1%, 2%, and even more. So I don't have a problem with them getting the monopoly. They are disrupting an old industry that is arguably, because of history, engaging in rent seeking. That is what they are disrupting. And the CEO has tremendous conviction. The CEO has about 33 million shares at a little more about 2 years ago. And look at the CEO. The CEO's net worth went from 1.2 billion down to 49 million per my calculations. I still think he's a centimillionaire, maybe about 100 million net worth. So it's a very successful person, but imagine seeing your net worth being divided by 12, 24. I mean, how much? It's insane. It's insane. The CEO as an Amazon-like conviction. Bezos saw his wealth being cut in half more than a dozen times with Amazon. That CEO has that conviction. And the reason why I say that CEO has that conviction is because despite the headlines, the CEO, in my opinion, has had substantial skinning the game, meaningful skinning the game from the founding of the company. He founded the company in 2014 until now. Substantial skin in the game. I saw headlines specifically on the last sell because these are computer written articles, right? Most of these articles that you see on the news are written by computers. So the last sell of the CEO happened to be 7,700 shares at $3 on October 11, 2022. And the article is like, oh, bad sign, insider selling, CEO selling for Opendoor. That's a $23,000 sell. Like, he sold $23,000 and it was an automatic sell too. That's not selling, that's peanuts. When you're a centimillionaire, when you have when you have $100 million net worth, most of it is in that stock, and you sell 23,000. That is not a newsworthy article. That is not Twitter worthy. That is not worthy of bleeding. I'm sorry, 23,000 of a sale is nothing. This is not a costly signal. This is not insiders selling like crazy. I see people on Twitter. Insiders are selling like crazy. They are not selling like crazy. Do like people. I think you should do a little research. They're not my listeners, of course, but people who say they're selling like crazy. The CEO is not selling like crazy, right? The CEO owned 2 years and a half ago 35.8 million shares, about 6%, about 6% of the business. CEO now owns 33 million shares in 2 years and a half. So the CEO sold 8% of shares in 2 years and 5 months. Can you really blame? And most sales, by the way, were in 21 when the stock was not in turmoil. Most of the sales were done in 21. So can we really blame a 39-year-old? I don't do People magazine. I don't know anything about CEO's life outside of a business. I don't do that. But when you research the CEO is a 39-year-old man with a family. Like, come on, you're in your prime. It's okay for you to sell 8% so that you can enjoy life a little bit. Selling 8% when you're 39 years old and you've worked tirelessly for Opendoor and whatever came before Opendoor, so you've worked tirelessly for 2 decades, it's okay for you to sell 8%. Like I really think it's okay. This is not a signal. This is not a signal. He's a 39-year-old married man who's going to have a family life, who's going to have a nice house. Why not? Especially if you're in real estate. Like, I don't have a problem with that. I'm not reading anything into this. If you read early stories of the CEO had very humble beginning. Was raised in a very thrifty, thrifty house. Very, very, very good values. I love doing the very few CEO interviews that you can find on him. I love them. I'm not blaming the CEO for selling 8% of shares in 2 years, 2 years and a half. That's like 3% a year. You're selling 3% of your shares a year. Not a problem with me. Not a problem with me. He's got another 30 years to go before he's out of shares. So the CEO is not out. There is no crazy insider selling. This is not a signal on which we should punish the stock, but the markets are punishing the stock like crazy. And like I said, I really mostly care about the CEO and what the CEO is doing, because insiders are not alike. All insiders are not alike. The CEO has the most information. The CEO is the most important insider. So reading into the insider sales of other members of a firm, to me, is meaningless. I care about the CEO, especially when the CEO is the founder, and Eric Wu is the founder. So again, when you see an headline, go calculate. Is it 7,000 shares at $3? Is it $23? And does it say automatic sell or pre-planned sell? And is the guy a centimillionaire? Well, in that case, that's not a signal. That's just noise. That's just noise that the market, the media is putting out there for clicks. That is what it is. So, an update on Opendoor. What is the current situation? Let's have some rational thinking about Opendoor. I said this in my prior video, but I'll say it again. Opendoor is slowing down its third-party platform. That's the platform when you go on Opendoor and you sell to Opendoor. Opendoor is now a picky buyer. If you go on Opendoor and you try to sell your house for Opendoor, they will give you an offer that is not lowball, but they will give you an offer that reflects the current market, i.e. they will give you an offer with high spreads for them, which means that homes bought in Q3 and Q4 will not have losses. Homes bought in Q3 and Q4 will be profitable homes because the spreads are very high. Try it for your home. Go to Opendoor, try it for your home, and try to see what they offer you. You'll see the spreads are very high. The losses Where they messed up, I'm not denying that they messed up. I don't think it's worth 95, 96% down in the stock, but it's certainly worth a little punishment in the stock. Where they messed up is Q1 and Q2. But this is not a bankruptcy-inducing event. The balance sheet, look at the facilities, look at the loan facilities that they got from their backers. They got tremendous facilities for their backers. The balance sheet can handle these losses. Also, the published loss is not realized. I mean, I can't emphasize that enough. The published loss has not been realized. It's an inventory value adjustment. How do you know they're going to realize the loss? How do you know the market is not going to turn around within a few months? I mean, we don't know. We really don't know that. I mean, if you're negative and you listen to the media, of course you think it's going to be doom and gloom for the next 5 years. But we really don't know. I mean, we absolutely don't know. I mean, remember, February 2020, everything was fine. Late March 2020, nothing was fine. So we don't know. We can't predict the future, and losses are not realized. They're selling these losses. They have a lot of institutional buyers. They're selling them, a lot of 100 homes in one area. Only Opendoor can do that. It's a big deal. I love that they do that. Lastly, and this is related to the fact that they haven't sold their inventory yet. It's like individual buyers do not strictly adhere to the Case-Shiller index, right? They adjust prices. They adjust prices based on Case-Shiller, right? Or whatever HPA measure that they use. I can't remember. But they adjust their prices in accounting terms. When they do markdowns for accounting, they use national measures and national estimates. But they don't use the emotional touch, right? When you buy a house, I am sorry, most home buyers who buy their primary residence, they have emotion. There's an emotional component to this buy. Okay, if you're a real estate investor, emotion you should get out. But if you buy a house for you and your family, there is necessarily going to be emotions. And I've read a lot of experiences of people who have sold homes on Opendoor. I've sold my home to Opendoor, and I can tell you that when they buy homes, there is a human process. Like there is a human process. You have an actual human looking at the home and deciding what offer to give on the home. They have a high definition video of the entire home. There's you filming your house with an entire discussion. They have their algorithms. They have everything. It's like it's like this little thing I've seen that Opendoor apparently only buys terrible homes. I don't know where this came from. Like I've bought 3 homes with traditional realtors. I guarantee you, I saw plenty of bad homes. Plenty. There's bad homes everywhere, and a bad home for one person is a home with a tremendous potential for another person. Like style differs. Like we all have different tastes. What's gonna be a bad home to you, maybe someone else's dream home, and vice versa. So even the concept of a bad home, I think is very tenuous, very tenuous. And assuming that Opendoor only has bad homes, anyways. Lots of reason why I think these losses may be lower than what most people think. So I said they're in hibernation mode. So now they're slowing down 1P, first party platform where they buy stuff. They're slowing it down and only buying homes, being picky, only buying homes where they think they're going to have high spreads. And this is what they're focusing on. List with Opendoor. That's the 3P platform. That's the third party platforms that they're going to focus on right now. So sell to Opendoor, it's a 5% service charge. 1% this doesn't change, it's always 1%. And list with Opendoor. What is this? It's a 5% commission. So the 0 to 1 move is still there. They are still 1% cheaper than traditional real estate agents. 1% cheaper. It's amazing. It's really amazing. 1% is a big deal. 1% is a big deal. 1% of value of your home could be an effective year worth of savings for someone with a high spending rate. It's a big deal. So it's a big deal. The fact that the real estate industry and real estate agents take 6% when you sell and 6% when you buy sneaky, by the way, because you don't see that you pay 6% when you buy, but you do. I think is outrageous. We live in a low marginal cost society where those rates shouldn't be that high. Opendoor is beginning by giving back 1%. I think that's a big deal. I feel like when people are confronted with selling a home, and especially if they're disappointed with the market and they need to sell their home, they're going to choose to go with someone who takes a 5% commission instead of going with a real estate agent who takes a 6% commission. I think they're gonna choose to go with an app. I think the app is gonna be a huge deal. They're going to choose to go with an app. I mean, I'm not criticizing real estate agents. Like there's reason why the industry is a legacy industry. It has been done this way for structural reasons. Like this is not necessarily someone's fault. But the nature of disruption is that today, with technology, transaction costs have no reasons to exist, at least at this level. And they have no reasons to be this high. And so that's why I think fundamentally Opendoor will win. Opendoor will win. And if it's not Opendoor, another company will win. So let me move on. I told you the value of the app. Like, sure, you're saving 1%, but you're also accessing a much better digital experience. I've done both with Opendoor, sold and bought. The digital experience is pristine. It's amazing. It's really fast, really great. Like fast closing. It's a true digitally native company, like all of the apps that we're used to dealing with nowadays. So the standards are very, very high. And again, not a dent on realtors in any way, but the app just doesn't cut it. Like the competition to the Opendoor app just doesn't cut it. I'm so sorry to see, but it doesn't cut it. It's a 2.6, very, very few downloads, 5 times less downloads than Opendoor. You know, and you have to sign up with a realtor first. You have to sign a contract with a realtor saying, well, I am going to only buy a house with you for the next 4 months, 6 months. Not only you have to sign a legally binding agreement, but then the app is not, the app is not very, very well rated. It's like, and I've bought homes with the traditional realtor system before, like I think most of us. The website looks like it's from 2005. It looks like a 2005 website. It's like the system is you get an email with a scanned business card from your realtor on the top. The business card is scanned. This is no dent. Like I am fully aware that there's going to be disruption if Opendoor succeeds, and Opendoor has been the subject of a lot of attacks. I'm fully aware of that, but the app is just not doing it. Like whoever develops these apps is not whoever develops the MLS is just unfortunately not as agile, not as good as Opendoor. It's like, anyways. One of the things that I say is like it reminds me of a dealership. Like it feels like going to a dealership. Or it feels like the war between, say, Best Buy and H.H. Gregg, where, you know, there's like lots of territory and like everybody's very territorial. And if you've dealt with a salesperson before, you have to deal with that person again every single time you go in. Like there is no, there is no common user interface. It's really, really through no fault. I really don't want to blame anybody, but it's like it's not aligned with the digital age anymore. It's just not aligned with the digital age anymore. It's just not aligned with customers' expectations. Customers expect an Amazon-like experience. That's what customers want. And so when I compare the Opendoor app, by the way, has a 4.7, versus a 2.6, and it's a common thing to value apps based on their numbers of users. It's a common thing to value apps based on how good the reviews are. Just scroll through the thousands of reviews of the Opendoor app. Reviews don't lie. Like scroll through these thousands of reviews, and you'll see that many of the terrible reviews that Opendoor gets is from angry real estate agents, which is also very sad. Not all of them. I don't want to say that, but there's been some backlash, which I will address the backlash in my next video. But there's been some backlash from the incumbent. The incumbent is obviously not happy with Opendoor, so the incumbent is going to fight Opendoor. That's a sign that you're onto something, right? When Blockbuster fights Netflix, when when Barnes and Noble fights Amazon, when Sears fights Walmart, that's a sign that you're onto something. So, anyways, I could go on, right? When DC current fights AC current, I could really go on. Anyways, it's a sign you're onto something. Um, and again, if you look at the success of the app, again, numbers don't lie. 500,000 apps, 100,000 apps. By the way, these numbers are a little low for apps because, of course, you're going to have the Opendoor app or the MLS app only when you're searching for a home. Like, my assumption is that as soon as you bought your home, you're going to obviously uninstall your app unless you're like acquiring a bunch of homes for like investing or something. So it's comparable. It's comparable. And again, the reviews, it's like it's the app is crazy good. The Opendoor app is crazy good. The user experience is crazy good. I realize if you have not experienced it yourself, you can't. It's harder to assess if you have not experienced it yourself. But I can tell you, I've experienced both, and it's day and night. I will never ever buy a home with the traditional process again, unless of course Opendoor goes bankrupt, but I don't think they're going bankrupt. So just the app, and this is kind of a provocative calculation, but you could do calculation based on apps. Like, you can divide how many installs or how many users by market cap and see how much you pay per user. And when I do this type of calculation, simple back of a napkin calculation, 10 million installs for Zillow. Zillow obviously has a very different business model. It's a very friendly website that anybody can use, but market cap is like 8 billion for Zillow. Opendoor is also a friendly website that anybody can use. So I guess I'm not saying Opendoor is bad. They're both good, but Opendoor obviously newer, much smaller app, 20x smaller than Zillow. But Zillow exited that business, right? So Zillow was a threat when they were into that business, but now they exited it. So Opendoor really has an open runway, growth runway, insane. But if you were to just value Opendoor like Zillow's based on the number of users, you would have $400 million of value just for that app, just for that third-party app. And that's at very depressed valuations, by the way. Zillow has also been heavily punished by the market, just like anything that has to do with real estate, because the market has decided that real estate is going to crash. And I think the market's wrong, but that's for another video. So yeah, I have no issue saying that the app alone of Opendoor is worth a third of the market cap. The app alone, like a $500,000 people app with these high ratings is not free. It's not free. It's a big deal. It's a big deal. You have network effects built in, major network effects. It's a big deal. So this should be part of valuation. Of course, no credit whatsoever for the app. And this is kind of my conclusion right here. And I'll just go briefly into that. Mr. Market, are you so sure that real estate will crash? That's a question that I asked to Mr. Market. And the reason why I ask that today is we may have seen today the NASDAQ, only index I follow, NASDAQ was up 7% today. Why? Because we've had a teeny tiny drop in inflation, which means the curve is slowing, which means that inflation may have been transitory after all. And of course, what do you see? The 10-year as the sharpest drop, I believe they said, since the events of 2020 or something like that. But it was a huge drop in the 10-year. And of course, mortgages are connected to the 10-year, highly correlated with the 10-year. The 10-year drops, mortgages will drop. So that is amazing news. We may get a Fed pivot. We may get a Fed pivot sooner than we think, because the CPI is lower than expected, and that will give the Fed a reason. I mean, at least a face-saving reason to stop raising rates, which they are looking for right now because the system is breaking. And there's really two ways the Fed stops raising rates. I believe the Fed will stop raising rates. They have no choice. They will have to finance the US deficit in 2023, which will be trillions, trillions, 2 to 3 trillion, I believe, because they will not have the tax revenue. Because everybody's tax loss harvesting. We're in a recession. People are losing jobs. They will just not have the tax revenue. And then entitlements are going to go up. Social Security went up 9%. It's going to go on over 9% probably next year. Like the government is going to have a huge deficit, and there will be no buyer for those bonds, which means that the Fed will have to resume QE, quantitative easing. They will have to, but they can do this in a face-saving way if the CPI goes down, because they can say, "Oh, look, we fixed it. Oh, look, it's what we did that makes the CPI go down." And I'm not going to go into the CPI and why it could go down, but also what I'll say is I believe the CPI will also go down because did you know, for example, that they updated how the CPI is calculated? CPI used to be calculated every 2 years. Not this year. They changed that. They're recalculating the CPI, and now, surprisingly, the CPI is going to be readjusted on January 1, 2023, while the CPI weights were supposed to readjust in 2024. I find it very interesting. So the CPI will be calculated slightly differently on January 1, 2023. And if I were to take a guess, I would say the new weights will be favorable to a lower CPI, or will be favorable to the Fed. So I just think the Fed may have a face-saving way to stop quantitative tightening, which is much better. I mean, we want that. We want a face-saving way for the Fed. It's better. Why create more turmoil by just showing the Fed, having to turn to QE because something breaks, right? And things have already started to break. But either way, I mean, to me, it's a given. To me, it's a given that QE is coming back. That's why I started this channel. That's why this channel is called Beat the Denominator, because I'm tired of hearing people saying that the Fed can continue quantitative tightening. They can't. There's too much debt. Too many companies in the S&P 500 are zombie companies. Too many companies have to refinance their debt. They have huge maturities that expire within the next few years. What are they going? If they refinance it at the rates right now, they're going bankrupt. The Fed, anyways, that's topic of another video. But that's why I just asked this. It's just a question. Are we so sure, Mr. Market? Are we so sure that real estate will crash? And I don't think so. And I could also say that there's lots of reasons why people buy homes that are not related to prices. Like, you buy a home because you want to buy a home. Homes are not a fully economic, rational purchase. Like, people have to have a home. It's not, it's not discretionary spending. You have to have a home. So anyways, I will talk next video about my conviction for Opendoor, and why I think, kind of a more theoretical viewpoint as to why it's so obvious the way business is headed. It's so obvious that mainstream real estate is going to be disrupted. It's very, very obvious. And that's why I have conviction into the company. That's why, it's almost like a vote. It's stakeholder theory. Opendoor may thrive because enough people believe in Opendoor, and I think they have tremendous customer advocates everywhere, and you can't go against the market. So again, in light of that, Mr. Market, do you really think Opendoor is going bankrupt? I don't think so. I really don't. Thank you so much for watching my video. None of this has been investment advice. I am not criticizing realtors. This is just the way disruption works. It's just the way of the world. We are moving to a new, more customer-centric digital era, and I just think it's inevitable. So stay tuned for my next video on my conviction and why I think Opendoor is the righteous way to go. It's really the righteous way to go. Thank you so much. Thanks for watching my video. not investment advice. Thank you. Goodbye.